Hey financial warriors, welcome to the show, and in this video I'm going to tell you how I built $100,000 worth of home equity in just 1 year. I'm going to tell you why that is a big deal and what you can do if you find yourself in the same position as me. If you like the sound of that, please subscribe for more videos like this. So first of all, what is home equity? Well, let's just go with the Investopedia definition. Home equity is the value of a homeowner's interest in their home. In other words, it is the real property's current market value less any liens that are attached to the property. So by liens, they mean any sort of loans or any other balances that are attached to the home's title. So if you have a mortgage of $100,000 and your home costs $200,000 at current market prices, your home equity or your interest in the property is $100,000. But if house prices then rise and your home gets appraised at a value of $220,000, well, your mortgage is staying the same, right? They're not going to increase that because your home value increased. It stays the same based on the price when you bought it. So your home equity would now be $120,000. You basically gained money through doing nothing, through just holding the property. And you actually gain a little bit of home equity every month as well as you pay down your mortgage balance, as long as you're paying it. So let's talk about my house. Now, we used to live in New Jersey and I worked in New York City. And guys, New York City is way more glamorous in songs and movies. In fact, even earlier when we actually lived in the city, we had a tiny studio in Queens. We then moved to an apartment in New Jersey. The decor was kind of dated. You can see my videos at the time. One commenter even said it looked like a grandma's basement, but hey, it was all we could afford at the time. Anyway, in 2019, we decided we wanted to move further away from the city up to Orange County, New York, and we put in an offer for this house, which was actually the first house we saw. Now, we offered using an FHA loan, and here's what the seller said. "I'd love to sell it to you, son, but only if you can qualify for a conventional loan. And oh, you've got 24 hours to qualify, otherwise I'm going to sell it to someone else." Now, you may wonder why he wouldn't accept an FHA loan, because you may see a lot of YouTube influencers or TikTok influencers saying, "Hey, want to know how to buy a house with only 3.5% down? FHA loan, woo, thank me later." But no, sellers don't like them because it takes longer to close, and the code for an FHA loan, like the building codes they have to adhere to and stuff, is more strict. Like, for example, he would have had to have installed a rail on the basement staircase. He would have had to have painted over any paint that was peeling, etc. Okay, so he would have actually had to do some repairs to the house himself. Now, there are ways that you can do it where you offer, in your offer, you say that you will do the repairs or something if you really want to do the FHA loan. But this guy had already bought another house. He wanted to move quick, so he really did not want an FHA loan. If you want to see a video detailing that story and telling you all about FHA loans, you can check out this video on my channel. Anyway, it was a painstaking 24 hours and I had to come up with $24,000 extra in cash for the down payment, but I did do it. And I remember I spent the first half hour of Avengers Endgame reading through and signing the contract on my phone because I'd booked a movie ticket, but I had to get the contract done before noon, otherwise I'd lose the house. So there was no other option. Damn you, Thanos. So I closed with a down payment of $49,000 and a loan amount of $196,000. And because I owned more than 20% of the property, or had over a 20% interest in the property, I did not require mortgage insurance, which gave me a lower monthly payment than I would have had with the FHA loan. So it was all good, and we moved into the house in July 2019. The value did start to increase a little bit after we moved in, and it basically fluctuated around the $250,000 mark for several months. And then the pandemic hit. Now, the pandemic didn't really do much to the Zestimate, but in June 2020, after things started to reopen, the market just went on fire as people scrambled to move away from New York City. And they all wanted to come to the area where I live, which is basically where New York, New Jersey, and Pennsylvania meet along the Delaware River. It's a really beautiful area. So in the 1 year period from June 2020 to June 2021, the value of my house rose from about $250,000 all the way up to $305,000, giving me a $100,000 interest in the property. If you go by the Zestimate, the current estimated price is $320,000, and the balance of my loan is now just $188,000 because I've been paying it down each month. So my current home equity could be as high as $132,000. That's up from just $49,000 when I first bought it, so it's an $83,000 increase. Now, it's all good just talking about this stuff for flex value, but why does it actually matter, and could I actually do anything with that money? Well, if I wanted to sell and then buy a similar house in the same area, I'd have to settle for a smaller house because a house of similar size would cost pretty much the exact same amount of money, so I wouldn't be making anything. However, what I could do is borrow against my home equity, and this would be tax-free money that I could then go and invest in rental properties or put to work in the stock market or YOLO it on some stock tip I got from Wall Street Bets. Now, there are two main ways to do this, and actually, in fact, there are more ways, but we're gonna look at two ways. And those are a cash out refinance and a home equity line of credit, or HELOC. Now, with a cash out refinance, I could probably take loan to value, or LTV, up to 80%. If you go beyond 80%, you'd have to have mortgage insurance, and most banks will not do more than 80% on a cash out refinance. Some are actually 75%, depends on the bank. But anyway, we'll use 80%. So let's say I really can get an appraisal for $320,000. Then my new cash out refinance loan at an LTV of 80% would be $256,000. And that means that I would be able to pull $68,000 cash out of the property through that refinance process. Now let's look at home equity lines of credit. These are basically revolving lines of credit, like credit cards, that are backed up by the value in your home. Now, if they go untapped, they do not accrue interest, but when you start to use them, then you do have to start paying interest on them and eventually returning the principal. Now, they normally have two periods: a draw period where you're spending the money and you make interest-only payments, and this can last up to 10 years, and then you have the repayment period where you actually start having to repay the principal and the interest. And in case you're wondering, HELOC interest is tax deductible if you itemize, and an advantage of a HELOC is that there are very little closing costs compared to a cash out refinance. And for me, I would be able to get about the same amount of money, $68,000, out of my home through a HELOC as I would with the refinance, just depending on my credit score, the bank, and what the appraisal came to with the house. But I think if I was to do either of these methods right now, I would choose the refinance. And that is because the current interest rate on my mortgage is 4.5%. If I did a refinance, I could easily drop that rate by a whole percentage point. Now, if I just did a term and rate, or rate and term refinance, I would be able to lower my monthly payment by a couple of $100, easy. I may even be able to do a small cash out refinance of say $20,000 whilst keeping my monthly payment exactly the same as it is now, and that's because I would be getting a lower interest rate than I currently have. But I gotta hurry up because the Fed has already said that they're going to raise rates this year, and that may even start to happen in as little as 2 months. If I lose the chance because of being too slow and we see rates going back up to the 4% range, then I will just sit tight and probably wait until my next investment opportunity comes along before I decide how I'm gonna fund that, whether that's through a cash out refinance or through HELOC or just accumulating money through doing business and working. I might not even need to do this, to be honest. But it's great to go through and look at the options, and it might actually be a really great option for some people. Now, cash out refinances and HELOCs are not without their risks, particularly if you hit on hard times and your income decreases, because remember, you do actually have to pay back this cash that you're getting out of your home. So you definitely want to speak to your CPA or your financial professional before thinking about doing any of the things that we talked about in this video. Guys, thank you so much for watching. Please leave your comments down below. Tell me your stories. Have you used any of the methods in this video? And if you're trying to build up capital to buy a house, a great way to do that is investing in the stock market. You can get 2 free stocks for signing up for Webull with my link down below. Check that out. It's a great deal. Please subscribe if you're new, and we'll see you next time. Bye-bye.